Welcome to Dr. Fred Markets. This is not financial advice. While most people ignore what's happening in the markets, a few choose to pay attention. And that difference, that simple choice to stay informed, changes everything. You're one of them. Let's get into it.
Your favorite safe whiskey is beating your 401k. SK Hynix just kissed a $1 trillion valuation off one drug, AI memory chips. Not phones, not PCs. One story. At the same time, auction houses are moving billions in boring barrels, rare single malt bottles compounding faster than most hedge funds. And while Texas politics is busy eating itself alive on cable news, the actual quiet power base, rich donors, old oil money, family offices, has been stacking status assets like art and whiskey instead of more tech beta. Here's the first real signal. The Knight Frank Luxury Investment Index shows rare whiskey prices up roughly 280% over the last decade, absolutely trashing the S&P's performance over the same window, and doing it with fewer stomach churn drawdowns. This isn't your grocery store bottle. This is finite, cask-numbered, never-again supply. Second signal. Look at what just happened with SK Hynix. AI Mania rocketed a previously cyclical chip name into the $1 trillion club because the story changed from semis are commodities to this is the picks and shovels for the AI gold rush. When a narrative flips from cyclical to sacred, money stops trading and starts hoarding. Third signal. Zoom in on high-end whiskey auctions. A single bottle of Macallan 1926 sold north of $2.5 million, and that wasn't a meme pump. That was pension fund tier capital and ultra-high net worth buyers treating glass and liquid like a bond with clout. The number of new whiskey funds and spirit funds has jumped from basically zero a decade ago to dozens today, complete with quarterly NAV reports and custodians. So here's the cliff. While retail fights over Nvidia at 40x earnings and index funds jam more AI risk into your retirement, the top 1% is quietly dollar-cost averaging into stuff you cannot replicate with a chip fab. Old wood, old grain, old time. Now the connection nobody wants to talk about. AI is training on infinite data. Whiskey is compounding on zero new supply from the past. Every new LLM model release kills another tiny sliver of human edge and information. But no model can synthesize a 1960s cask that was already bottled, stored, and allocated. That's a hard cap. Markets are starting to bifurcate. On one side, infinite scale assets, SaaS, chip software, margins big, stories huge, supply functionally limitless as long as electricity flows. On the other, finite flex assets, land, art, vintage cars, rare watches, and yes, top-tier whiskey, things whose status yield goes up as the digital world gets more crowded and more synthetic. The lesson: rich people are not diversifying for fun. They're front-running a future where AI makes it cheap to mimic knowledge, but very expensive to own anything that proves you're not a deepfake with a leased Tesla. Mechanism time. Whiskey appreciates in three ways. First, evaporation. In the cask, 1 to 2% of volume disappears each year as the angels share.
Let's pause for a second. Ask yourself this. Do you really understand what's happening in the markets right now? Do you know how this affects your money, your savings, your future? Most people don't, and that's exactly why you're here. Let's keep going.
That's literal shrinkflation of supply. Less liquid, more scarcity, higher price per remaining liter. Second, graduation. Once bottlings cross certain age and hype thresholds, think 18, 25, 30 years, limited editions, closed distilleries, they graduate from drinkable to untouchable. Every bottle opened in a Tokyo bar destroys one from the resale market and bumps the floor for the survivors. Third, financialization. The moment funds and family offices commit mandates, we put 2% into rare spirits over 10 years. Demand stops caring about seasonality and starts behaving like an annuity. That's how you transform a hobby into an asset class. Here's the one concrete thing you need to learn today. Whiskey isn't just collectible. It's time arbitrage. You're buying other people's impatience and selling it back to them 10 to 20 years later with compound scarcity attached. So what can a normal investor actually do without LVMH money? 1. Stop treating alternatives as a meme. You don't need a whiskey fund, but you do need an alternatives bucket in your mental portfolio. Maybe 5 to 15% over the next decade into scarce, real-world flex assets you actually understand. That's the shift, from 100% paper stories to at least some bottled reality. 2. If you go into whiskey, get professional about it. Stick to globally recognized names with deep secondary markets. Macallan, Yamazaki, Hibiki, certain spring banks. Check auction histories. Look for limited releases, age statements, and documented provenance. If you can't verify storage and authenticity, walk away. You're not a collector, you're exit liquidity. 3. Separate drink from invest. Your daily sipper is an expense. Your sealed, insured, properly stored bottles are inventory. Mixing them is how amateurs torch returns. This is not financial advice, but here is the truth. Index funds now load you up with infinite digital stories. If you want real diversification in an AI world, you need at least one asset in your life that can't be copy-pasted, mined, or forked. Summary: 1. AI is inflating infinite-scale assets. The top 1% is quietly rotating a slice into finite status assets like rare whiskey. 2. Whiskey's return engine is simple: evaporation, graduation to untouchable, and financialization by funds. Time does the compounding, not volatility. 3. Your move: build a tiny, educated allocation to real-world scarcity you actually understand, or accept that your entire net worth lives and dies on the same AI narrative. If this taught you something you have literally never heard on another finance channel, subscribe. Tomorrow we talk about the next asset your advisor doesn't cover, and why that's exactly where the edge starts. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.